Feliz miércoles. That means happy Wednesday in Spanish. Welcome, welcome to another weekly Wednesday webinar. It's interesting, panelist team, how, during the winter time, fall time, we say good evening because, it gets dark pretty quick. But now since it's spring and, we're getting the longer days, we say good afternoon, right? But no matter where you are, whether you're in the West Coast, the East Coast, the North side, the South side, we're just happy that you joining us in another weekly Wednesday webinar. My name is Eddie Villanueva, and I'm the Engagement and Events Manager here at the United States Senate Federal Credit Union. And also, they say that I'm the MC of the weekly Wednesday webinars. I don't know why. I'm a little shy. As you can see, I don't like talking, but hey, we just want to say welcome to everybody, and we're so excited to have you here with us. And we're gonna, as you can see on the screen, you can see the topic, Mastering Your Credit, a National Credit Education Month webinar. As you know, credit can be a little tricky. Sometimes you might be like, do I have enough credit? Do I not have enough credit? If paying my bills on time is gonna help me, should I pay off my credit cards, all of that? We're gonna cover it all. We're gonna talk about credit and how important it is to have good credit. Thank you, everybody that's joining us. I see a lot of familiar names. So thank you for those loyal supporters that come each and every Wednesday to support these weekly Wednesday webinars. And if you're new, we want to say welcome to you. We hope that you can, enjoy the presentation this evening and you can learn something new as well. As usual, we want to also remind you that if you have any questions, any concerns, any comments that you would like to tell us, if you just want to say hello, panelist team, if you want to just say, hey, thank you for doing this, whatever it is that you want to tell us, or even suggestions, you can use the chat or you can use the Q&A feature. If if you send all of your questions to us, we have an expert. Her name is Andrea Londono. And then what are we going to do with all those questions and comments, Andrea?
We'll answer each and every single one of them.
All right, we're gonna answer each and every one of them, So we just want to say once again, thank you very much. Welcome for being here. And we appreciate your support with these weekly Wednesday webinars. This is our season 3. We've been doing this for 3 seasons now. And without your support, this wouldn't be possible. So thank you, thank you, thank you. With that being said, panelist team, I believe it's 6:00. We want to be mindful of people's time. I know you want to spend time with your family, or maybe you're spending this webinar with your family. So if you're doing that, that's amazing. But I just want to introduce the rest of the team. No specific order, but I want to introduce Andrea Londono. She already care of mute. She's our main specialist. She basically marketing with content to help us. So Andrea, thank you very much. And as I say, she will be reading the questions live after the presentation. We also have Carrie Lazar. She's one of my mentors when I came to the marketing department 3 years ago. She took me, she helped me out, and everything that I do now is thanks to her because she showed me the way. She's our senior content manager. I hope I got that right. She's always getting promoted, so I'm trying to learn from her. But Carrie is responsible for all that content that you see on the screen, all the slideshows, and all the good content that you get post after that, the webinar. So, Carrie, thank you very much for all you do. We appreciate you. And last but not least, our superstar presenter, Kim Fridley. She works with the membership development team. She's the membership development analyst, and she's here to answer all of your questions about membership, the credit union. If you want to contact her directly, you can call at 1-800 and you do awesome for being here. Thank you for all the support to the attendees, and let's rock and roll. Kim, please take it away from me.
Thank you so much, Eddie and Carrie and Andrea. And welcome. We are going to talk about mastering your credit tonight. It is National Credit Union Education Month, and we have a whole lot to talk about. So let's go ahead and dive in. So in front of you, you can see our agenda. Like I said, we have a lot to cover this evening, and it is all key to understanding your credit report and your credit score. So we're going to start out, we're going to talk about why credit is so important. Then we're going to take a look at credit reports, what's on them, and how to actually obtain yours. And then we're going to talk about how credit scores are calculated, what kind of factors go into your credit score, and how to build credit if you are new, young, and just first starting out with lenders. So we're also going to talk about a couple common credit myths before we wrap up with some tips on using credit cards wisely. So before we get started on the ins and out of credit reports and scores, it's really important that we take a step back and consider why. Why is credit important in the first place? So believe it or not, having good credit may help you land your dream job. Don't know if you know this or not, but we're all about giving you some data. 38% of employers do credit checks. And this doesn't mean that if you have bad credit, that it's going to prevent you from finding a job, but it could be used in determining if you will be offered certain jobs. And we want to make sure it's important to note that employers do not have access to your credit score. They only have access to your credit report. And whether or not credit is a factor in gaining employment, it largely really depends on the industry that you're applying in. So if you work, let's say, in a financial institution or in finance, it could definitely be a big factor, as well as, for jobs requiring security clearance. And we love to give you guys examples. So I'm going to give you an example of, let's say you wanted to get a job at an airport. TSA, of course, is the Transportation Safety Administration. They will do a credit check on all prospective employees. If you owe $7,500 or more in unpaid debt that's in collections that you've not paid, they're only going to hire you if you show a plan to pay the debt back. Your credit history also comes into play when you, yes, rent or purchase a home. So even though renting doesn't actually involve borrowing money like you would if you were purchasing a home, most rental management companies still want tenants with decent credit. It just indicates that you are more likely to pay your rent as agreed on a monthly basis. So if you're purchasing a home, credit plays a big role. We all know that in determining if you're going to actually be eligible for a mortgage. Getting a loan when you need it. Finally having good credit might make the difference in getting a loan when you actually need one. Anytime you need to borrow money, your credit is going to play a really big role in determining the terms of that loan. But what happens if you want to borrow money and you don't have good credit? Have you heard or seen any advertisements that say bad credit, no problem? While these places can often approve you for a loan, it's more than likely going to be a really high interest rate. For an example, you might get an auto loan at a 25% interest rate. I mean, that's just ridiculous. We really call them loan sharks. And that might translate to a monthly payment that could even be double or triple what someone with good credit might pay. So it really, really is important. Let's take a look at some examples at two people who are applying for a mortgage. For sake of discussion, let's say all other underwriting pieces for Diego and Angela are equal. So their amount of income, their stability of income, etc., are equal. While Diego and Angela may both get approved, let's take a look at how their difference in credit scores impacts the term of the loan. And while it might not seem like a big difference, if you spread it out over 30 years on a large loan, a difference in credit scores can translate into literally tens of thousands of dollars. So in this example, having a higher credit score saved Angela $34,258. So, Diego might want to consider focusing on increasing his credit score before buying a home. A lot of times we will tell members, if you know you're going to be purchasing or refinancing, pull your credit, make sure that you have the best score, give yourself at least 6 months, sometimes even a year, depending on what your credit looks like at that time. People don't want to miss out on purchasing their dream home, right? So in terms of low interest rates or low real estate prices, that's when they're anxious to buy. So it's always a good idea to start at least 6 months before you're ready to purchase. Jumping into a large purchase before you're ready credit-wise, it could mean your dream home becomes more of a nightmare. It really could. So now we're going to turn our attention to credit reports. As a credit report contains some of the most important pieces of information that creditors are going to look at when determining if and at what terms they are willing to extend credit to you. There are 3 major credit bureaus that collect your information and generate credit reports. There's TransUnion, there's Experian, and there's Equifax. So when it comes time to apply for credit, it depends on the financial institution as to which report they're going to actually pull. So in some cases, like when you apply for a mortgage, the lender might review all 3 credit bureaus: TransUnion, Experian, and Equifax. And this is part of why it's important to stay on top of what is reporting with all 3 credit bureaus. And it's recommended, that you review your credit report consistently. It used to be, we would say, once a year. Really, quarterly, twice a year. It's really, really critical. And different information may report to different credit bureaus. It just depends on which credit bureau the lender that you have a loan with is reporting to. In many cases, information may vary slightly, as some creditors may only report to one and some creditors may report to all 3. It just depends on the creditor. So let's talk about what is actually on our credit report. So your credit report contains your, and I'm going to say NPPI, non-published personal information. This includes your name, your social security number, your date of birth, your address, and sometimes even your employer. This is used so that whoever is accessing your credit can match up your information, your identity. And this personal information is not used at all when calculating your credit score. So second, credit account. So this includes credit cards, personal loans, auto loans, mortgages, any student loans that you may have, and any other type of debt. Your credit report is going to contain information about when you opened that account, if your payments have been made on time or not. It's going to show your remaining balances and your maximum credit limits. So payments will show up as late if you are 30 days or more past due. You want to make sure that all of your payments are on time. You never, ever want to go to that 31 day, because most all creditors are going to report it to your credit report, and it stays on there for a long, long time. So other household bills like rent or utilities, they generally do not show up on a credit report. However, if you were to stop paying any of those bills, you can guarantee they're going to show up, especially if they've been referred to a collection agency. So once in collections, the collector can report that debt, at which point those outstanding debts would appear on your credit report. So make sure you're looking at your mail. Make sure that you're paying, whether it's hospital, doctor, cable, anything like that. They can actually, at a certain point, report it to your credit report. So under the Fair Credit Reporting Act, debts can generally appear, here we go, on your credit report for 7 years. And in a few cases, longer than that. So just think, if you hit that 31 day and you didn't realize it, we're talking 7 years on your credit report. And then there's public records also, which are things like bankruptcy, tax liens, judgments. They can stay on a credit report for 7 to 10 years. Long, long time. And finally, anytime someone accesses your credit report, it is called an inquiry. There are actually 2 types of inquiries. There's a hard inquiry, which is anytime your credit report is reviewed for the purpose of extending credit to you, such as, applying for a loan. So a soft inquiry includes checking your own report or when a current or potential creditor wants to make you a promotional offer, and we all get them in our mail. So while both hard and soft inquiries will appear on your credit report, only the hard inquiries will impact your credit score. So let's talk about what is not on your credit report. Your credit report does not contain information related to how much you make, your income, any assets that you may have, or any savings accounts that you may have. So a person can have excellent credit, but no savings. Or let's flip that, be very wealthy, but have really bad credit. So this is why lenders often look at all of these pieces of a financial picture. They look at the entire picture. Income, assets, savings, credit, when they make lending decisions. And just remember, a credit score is not a financial health score. That's really important to know. There is no requirement in the Fair Credit Reporting Act for credit reporting agencies to remove positive information, such as on-time credit payments. They can remain on your credit reports indefinitely, especially if the account remains open and active. Even after a positive account has been closed or paid off, it can actually still remain on your credit report for as long as 10 years, which is a good thing. And please excuse Winston, my 65, 70-pound chocolate lab. He loves to help me give these webinars. So having more good information, helps strengthen your credit history and can actually increase your credit score. It's also important that information on your credit report is accurate. That's another reason why we tell you we all need to pull our credit reports consistently. According to a study conducted by the FTC, which is the Federal Trade Commission, 1 in 5 people have an error on at least one of their credit reports. I would love to know how many people are on this webinar and figure out the ratio of how many of us could actually have an error on our credit report. So let's talk about how to get a copy of your credit report. It is recommended you review your report. We already talked about this at least once a year to make sure everything is accurate and ensure you're aware of everything reporting. I recommend you do it more often than that because fraud is at an all-time high. And if, God forbid, your identity were stolen, the quicker you find it, the quicker you're going to be able to get that resolved. So you have the option of getting all 3 credit reports at the same time. If you have never seen your reports, this may be a really good idea, really good time for you to do that. However, another option, if you wanted to, you could stagger your credit reports. Now you can actually get all 3 credit reports as often as you would like ever since the pandemic. So highly recommend that you pull all 3 reports just to make sure, again, that what they're reporting is actually what you owe. And to also make sure you're not identifying anything that you didn't apply for. That's where it could be a case of identity theft. So the recommended place, this is really important too, to get your credit report is annualcreditreport.com. It's the website that was set up as a result of the Fair Credit Reporting Act that states that you are entitled to receive a free copy of your credit report from each of those 3 credit bureaus. And it used to be once a year, but during the pandemic, credit reports were available for free once a week. So this has now been extended indefinitely. So meaning you now have access to all 3 of your credit reports on a weekly basis. Highly recommend you are doing that. So when you go to annualcreditreport.com, you should see this same logo in the upper left-hand corner of your screen. It's best to type this full and exact website into your internet browser because there's a whole lot of imposter sites. So look for the logo indicating you are in the right place. That's really for any website. Don't just click on websites through emails or text messages. Go out, open your browser, and type in the URL yourself. So before receiving your reports, you will be asked several security questions. There could even be trick questions. And let me give you an example. It might say that you opened a mortgage in May of 2008 and ask the name of the lender. If you have never taken out a mortgage, the answer might be not applicable. Keep in mind that these questions are meant to ensure that you are who you say you are. Again, protecting your identity. There's also a form that you can use if you prefer to request your credit report by mail. So the form can be found online at annualcreditreport.com, or you can call, you see the 877 number in front of you to receive it. If you anticipate the need to borrow money, again, we're going to suggest that you review your credit reports at least 6 months prior, so that if there's any errors, you have time to correct them before you actually apply. And please note that only the credit reports are free, and that's the actual history that shows your lenders how much you owe when you took that loan out. If you want to obtain your scores, they're actually going to make you pay for it. So we recommend that you don't do that because we provide you your Experian score for free every month. So that's something that you can opt into on our website when you're logged into your account. There is a law that requires a lender to provide the credit score they used if they make an adverse action decision, meaning they weren't able to approve your loan for credit. So this includes being denied for a loan, a credit card, or getting approved at an interest rate higher than the best rate being offered. We don't recommend applying for something knowing you'll be denied just to get your free credit score. That's going to be a hard credit pull, and that's going to impact your credit score even more. If you do find inaccurate information on your credit report, you absolutely have the right to file a dispute. First, you're going to want to dispute the item with the creditor or collection agency that reported to the credit bureaus inaccurately. You're going to have to go back to the source. If that doesn't resolve the issue, you can also file a dispute with the credit bureaus that you are reporting the inaccurate information. You should include all documents to support your dispute, and you're going to need to allow 30 to 45 days for them to complete the investigation. Could even be longer. You're going to file it with the Consumer Financial Protection Bureau, CFPB. And if you're still unsatisfied with the outcome of the dispute, you can file a complaint with the consumer. We just talked about that. Sorry, CFPB. If you find indication that your identity may have been stolen, you're going to want to take action immediately. You're going to want to contact all 3 credit bureaus to place a freeze on your credit, and this prevents anyone who has your information from continuing to open accounts as you. You can typically do this by calling the credit bureaus, or you can go online to their websites. It's really important to note that this freeze prevents anyone from applying for credit with your information, including you. So if you plan to apply for credit, you're going to want to lift that credit freeze prior to applying for that credit, and then you can put it right back on. It's also recommended that you file an identity theft report with the FTC, with the Federal Trade Commission, at identitytheft.gov. This report actually walks you through additional steps to take. You know, making sure that you understand what's on your credit report and making sure the information reporting is accurate, it's really important, because your credit report is used to calculate your credit score. Some people call it a FICO score. So a credit score is a 3-digit number that uses the information on your credit report to quantify the likelihood of repayment. It reviews how you've managed previous accounts. It's meant to reflect how risky it may be for a creditor to extend new credit to you. And scores range from 300 to 850. Although it is possible to have a 0 if you've never had any credit. So young adults, a lot of times, will have a 0 credit score just because they've not had to apply for any credit yet. The lower the credit score, the higher the risk an individual appears to a creditor. So you want your credit score to be high, that number. The FICO score is the most widely used scoring mode. Another mode is the Vantage score, which is often used by sites that offer free credit scores. Because there are different credit scoring models, your score may vary depending on where you check it. And this doesn't necessarily mean one is wrong. It just means different scoring models look at slightly different things. But 5 key factors go into the calculation of your credit, your FICO credit score, which is, again, the most common scoring model used by creditors and lenders. So credit score factors, the largest factor that's going to impact your credit score is payment history. Making every payment on time every month is one of the very best things you can do for your credit score. The second largest factor impacting your score is the amount of debt you owe, which includes credit utilization. So creditors want to see loan balances decreasing, not hovering or increasing over time. So credit utilization specifically looks at revolving credit accounts like a credit card. So where your balance could go up 1 month or it could go down the next. So credit utilization looks at how much of your credit limit you are using. The more credit limit you are using, the more risk you are to a creditor. So if you have multiple credit cards, add up your balances, divide them by the total of your maximum limits, and that's your utilization rate. Ideally, you do not want to be use more than 30% of your limits at any time, and even more ideally, pay off your balances in full each month. That's really going to help your credit score. Lengths of credit history. The length of credit history looks at how long your credit accounts have been open. This makes up 15%. This includes the age of your oldest account, the age of your newest account, and the average of all of your accounts. The longer your credit history, the better. And then 10% is new credit. So, which is where those hard inquiries we discussed a little bit earlier are reflected in the credit score. So if you start applying for credit frequently, this can be a red flag to creditors because they start to wonder what is going on, that you suddenly need a new credit card 1 month, a new loan the next month, and now you're asking for another credit card this month. The worst thing you can do is when you go shopping and you go into a retail store and they say, would you like to save 10% on your purchases today? If you do that, it's going to be a hard hit. It's going to impact your credit score, especially if you do it over and over and over, like the day after Thanksgiving. Of course, we typically all need to apply for credit from time to time. We know this, which is totally understandable. The key, though, is being strategic when you do apply, limiting those hard inquiries to only when you need it. Hard inquiries typically remain on your credit report for 2 years. And finally, credit mix is the last factor that impacts your credit score. Creditors want to see that you have a history of being able to manage different forms of credit at the same time. So let me give you an example. Maybe a credit card and a car loan and a student loan. This is one of the smallest factors, 10%, impacting your score, but it can help to have a well-rounded mixture of types of credits when they are all managed responsibly. So here you can see, although some areas have a larger impact on your credit score, all 5 of these factors play a unique and important role in calculating your credit score. So let's look at what we learned in the last couple slides about credit scores. In this example, we're going to look at Diego and Angela again. And for our purposes, each of them only has one, we're going to say they only have one credit card on their credit report. Diego spends $800 on his card each month. His limit is $1,000. Each month when his bill arrives, he pays the entire balance off, avoiding interest charges. Angela, on the other hand, carries a $5,000 balance. She also pays on time, but is only making minimum payments. Her limit is $10,000. Who do you think has a better score and why? Believe it or not, it's Angela. Angela has the better credit score, despite being in more debt and probably taking years to pay down her balance, plus a bunch of interest. There is one thing working for Angela, and the ratio of her balance to her overall limit. Her utilization percentage is 50%, whereas Diego has an 80% utilization rate. So with that being said, while Angela may have the higher credit score, we all know that Diego is in a better financial position. Next month, he can simply charge less on his card, and within 30 days, his score should improve. So Angela may struggle to pay her debt down, because she only is able to afford those minimum payments. So credit scores are a piece of your financial situation, but it's really important to remember a credit score, I'm going to say it again, is not a financial health score. So now let's turn our attention to how to build credit if you have either never had credit or are trying to rebuild your credit following a setback. As you focus on building credit, you'll first want to review your goals. Know what you are trying to accomplish. That's going to help you determine the steps that will help move you forward. So also, before building credit, consider how financially stable you are. Have you developed a written budget? Do you have to know what income is coming in, what debt is going out, what payments are going out? Do you have consistent income, and is it enough to cover your monthly expenses? Do you have at least several $100s in savings to cover a minor emergency? If you open a credit card or add a loan payment while you're struggling financially, this could end up, negatively impacting your credit score. One of the most common ways to build credit is really by opening a credit card. Using a credit card for a budgeted expense and paying the balance off in full monthly is a great way to start building a strong credit history. A secured credit card requires you to make a deposit up front, and that deposit becomes your limit on the card. For example, if you deposit $300, you'd be given a credit card with a limit of $300. We actually don't do that here at our credit union. But just like a regular credit card, you use the card and get a bill each month with a statement balance and minimum payment due. And that is reported to the credit bureau. You would still pay interest, of course, if you don't pay the balance in full. And if you make a late payment, you will still be assessed a late fee. This could still negatively impact your credit score. So it is a balancing act. It comes full circle. Your security deposit is only touched if your account goes into default and is not repaid. So other than making a security deposit up front, the key is treating a secured credit card the same as an unsecured credit card. So keep your balances low, make your payments on time every single month, even if you have to the best thing to do is set it up on automatic pay. But even if you have to set something up on your phone, in your calendar to say, hey, you need to make this payment, it is imperative. And even do it early so that you don't have to worry about it just in case something happens on the day that it's due and you're not able to pay it. A secured credit card is often used to help people actually with no or low credit rebuild, as it's less risky to the issuer because of the security deposit. So as your credit score improves over time, most time you will eventually receive your deposit back from the creditor. So keep in mind, a prepaid debit card is not the same as they don't report any information to the credit bureau. So we're not talking about a debit card that's tied to a checking account. So a secured loan, this is something we do offer here at the credit union. A lot of our members use this option. It's also a really good way to build credit. And with this type of loan, with a secured loan, a deposit is used to make payments on a loan. What we do here at the credit union is you put the money into a certificate of deposit, a CD, and we will allow you to take a loan on that certificate of deposit at 2% above whatever the dividend rate is, but you're still earning the dividend rate. So it's literally like a 2% loan. Here, the advantage is that you can usually set up payments automatically. You'll want to talk over the options of building your credit with your financial institution to ensure you're using the right product based on your goals. So here, we would give you the loan. I think we do 80% of whatever the CD is. It can only be for the term to the maturity date when that CD becomes mature. And then the nice thing about that is you pay for whatever, a lot of people use it to buy cars. You actually pay your loan, and when you pay your loan off, you still have all your savings money, all that CD money, which is really nice. You also have two choices when it comes to using someone else's credit. A lot of young people will do this to build your own credit. And the first is getting a cosigner or a joint owner for loans or credit cards. It's really important to know, however, that both parties are absolutely legally and equally liable for the debt on a joint account. And typically you have to reside in the same household. So if you plan to go this route, there is risk involved that is important to weigh and have a clear agreement in place with the other individual that is actually using you as a cosigner. Another option is being added as an authorized user to a credit card. Authorized users are not considered account owners, so the authorized user is not at all in any way, shape, or form liable for the debt. However, any activity on the account will be reflected on your credit, good or bad. So if you're considering asking someone to add you, or you're going to add someone as an authorized user, make sure it is someone that you trust and to make their payments on time and keep their balances low to ensure this helps you build credit and doesn't end up harming you. It's going to be not you, the authorized user, that's liable for those payments, but the person who actually took the credit card out. So let's talk about a couple of the most common credit-related myths that you may have heard and why they are not necessarily true. Myth number one is something that we hear a lot. Closing a credit card will hurt my credit score. This is more of I'm going to say a half myth. It all depends on the person's situation. So let's take a look at a couple examples. So you see Sarah. In Sarah's case, she has 3 maxed out credit cards. Since she is using 100% of her available credit, the utilization portion of her score suffers already. Now she pays off the first card, so her available credit increases. So her credit score is going to improve. So then she decides to close it. So she is not tempting to use it again. But once she closes the card, her available credit on that card disappears. So she's left again with a utilization ratio of 100%, and her score goes back down. Remember, the other two cards remain maxed out. So in Sarah's case, closing her card has hurt her credit score. In Katie's case, she has 5 open accounts, and her starting utilization ratio is great because you can see she's using very little credit. So closing one of her cards will have very little effect on her utilization ratio. So her credit score will not be affected as significantly as Sarah's would be, though she still may see a little bit of an impact. This is a really good reminder that credit scores are not financial health scores. So Sarah closed that card to remove the temptation to continue charging on it. Yes, her credit score may have been impacted negatively, but she made a financially wise decision for herself. Bigger picture. This is another reason setting your goals and having that budget is an important part of this. If Sarah's goal is to get her debt paid off and she isn't planning on needing to apply for a new credit card anytime soon, then her goals can help her make different decisions than if her top priority is improving her credit score to get like the best rate on a loan. Just all depends on what your goals are. How many of you have heard this? Checking my credit score will hurt my credit. Checking your own credit report, it's considered a soft inquiry and it has no impact on your credit score. So check your own credit report or your score as often as you'd like. You can get it free if you're a member here at the credit union through your online banking portal. It will not change your score. This myth is derived from the fact that applying for credit too often can hurt your scores. Like we discussed earlier, when you apply for credit, it is considered a hard inquiry, which is different from the soft inquiry when you check your own credit. So since credit cards are one of the most common methods people use to access credit, we're going to wrap up our workshop webinar this evening with some tips for you to help you use credit cards wisely. Having money in savings as a backup so that you can handle an unexpected expense without getting into debt using your credit card, it's a really good place to start. Excuse me. Consider only making one charge a month and make this charge an automatic bill like internet or cell phone. The reason we suggest setting up only one automatic charge is that you only need to generate activity to build your credit score. It doesn't matter how much activity. So in fact, the smaller the balance, the lower your utilization. And as we've learned, this accounts for 30% of your FICO score. So committing to use the card for only a small automatic expense you'd pay for anyways and leaving your credit card at home, lock it up, hide it, it can help you avoid temptation of overspending. The lower the utilization, the better. A general rule of thumb is to use less than a third of your available credit. For small limits, this means only charging a very small amount. So it's important to know both your limit and that 30% number. And while paying off an account in full does not improve your credit score per se, paying on time is really what matters. Paying off the balance in full can help you avoid paying additional charges. It will also help you to live within your means without increasing your debt. And I can't say it enough, make sure that you are checking your credit report and score consistently, regularly for for accuracy. And if you want to take a closer look at your specific credit situation, you are more than welcome as our member, and you're encouraged to call our partners at Green Path Financial Wellness for a free confidential financial assessment. They are certified counselors. They can review a soft pull of your credit report, which is not going to impact your score. They can go over, if you're not used to seeing what is on a credit report and maybe not being able to read it clearly, they can help you with that. They can talk about steps to help you build and improve your credit score based on your unique credit history. Everybody's financial situation, credit situation is different. No one's is the same. They can also take a look at your budget with you and help you to develop an action plan, help you to work towards other financial goals that you may have. They are really amazing. They can also talk about other financial concerns or goals that you have related to things like housing, student loans, any debt, but they can also really help you review and understand your credit report. So if you would like to at any time ever to a Green Path financial counselor, they are truly financial wellness experts. You see the number in front of you. We highly encourage you as a member. It is a free consultation for you to talk to them. Again, we partner with them because they are all about the mission of people helping people. So that is the end of our presentation this evening, you guys. Hopefully you got something from this presentation. And thank you for joining us.
Kim, I was not lying when I say you're our superstar
Oh,
presenter. You did such an amazing job.
thank
Thank
you,
you very
Eddie.
much for going over those slides, giving us that information.
Yes, sir.
Especially because sometimes we think that, you know what, just because I have a certain credit or because we've been doing this credit thing for such a long time, we're like, I think I know it all. But it's always it's good to know to go over this, bullet points, these slides, this information to make sure that we stay up to date. Because many people, for example, they didn't know that they perhaps could pull their credit, weekly. Back in the day, it was once a year, like you're saying. Otherwise, they would charge you. But now it's, we have all these tools that we can use to check our credit quite often, especially with, fraud being, a hot topic that we always talk about. We want to make sure that our attendees and our members get this information as well. So thank you very much, Carrie. I was in line when I said that you are amazing with the content. I think you did great as well. So thank you very much for that. And a couple comments on the chat. They're saying thank you, so we want to say thank you actually, because you were here with us and you joined us and you
Right.
learning together with us, because even though we're the ones presenting this content, we're learning as well. With that being said, Andrea, I think it's time to shine. So no pressure, but I think I saw a couple of questions on my end. So please take it away.
Yeah, of course. So the first comment slash question we have is, do these credit reporting bureau, yeah, I can't speak, bureaus,
Euro.
thank you, bureaus, share my personal information with vendors? From personal experience, I get an increased number of marketing phone calls slash scams. Are they protection for consumers like me that prevent my personal information from being shared with third parties?
That is a great question. I do believe, and if somebody wants to help me out with this question, that the credit bureaus share some of your information, but nothing like the NPPI, the non-published personal information. It could also be whoever you borrowed the money through, your creditor. The law allows you to opt out of any type of sharing of your information. So I would first start with the lender, the financial institution. Like here, you can ask us to opt you out of sharing your information, and we will gladly do that for you. Carrie, do you have anything specific for that?
Yeah, so I'll share the
Good.
link in the chat, but the Consumer Protection Agency or one of
Yeah.
those legit organizations, that's they provide a link to opt out of those types of offers, credit card offers and insurance offers, because experience in TransUnion, they do share your personal information with marketers. So let me throw that link in the chat. It's free to opt out. And just like you do on the Do Not Call registry, and you can learn more about what I'm talking about just by looking at that website. They say it better than I do. But you can opt out of that is the bottom line. And it's pretty easy to do. I think it lasts 5 years.
Carrie, is it the optouts
Thank you, Carrie.
prescreen.com website?
Yes, let me throw,
Okay,
I've shared it
I'll
in
share it.
personal chat, but I'm gonna throw it in the
I'll
chat so
share it.
everyone can see.
Perfect. Thank you, Andrea.
How reliable is the credit score that banks publish? For example, Bank of America sends me a FICO score weekly. How accurate is the score, and can I use that when negotiating for a lower interest rate on a car loan?
Excuse me, I'm so sorry, you guys. I have a bit of a cold. So, am I understanding you to ask, um, is Bank of America what they're reporting to you as a soft, kind of like what we offer our members? You can log into your US Senate account. You can opt into getting your experience score once a month. We do it once a month, not once a week. So, it really is all going to depend on the credit scoring model that Bank of America uses, because there are, believe it or not, several models out there. And there are also, believe it or not, a lot of different scoring versions. It depends on what credit bureau they're using. Experian, TransUnion, and Equifax a lot of times are not going to report the same credit score. I hope that answered. I don't know if that answered your question or not.
Yes, I believe you did, Kim. I understand what the member is saying, because I do have oh, I'm sorry guys, I do have another financial institution besides the credit union, so please don't get mad at me. But they do send me an email weekly saying like, hey, this is your new score. So like Kim was saying and emphasizing, these companies use different criterias, different softwares that can give you an idea of what your credit score estimate might be. It might be a soft pull, like she was saying. But if you want to negotiate for a lower interest rate, most likely will be a hard pull, correct, Kim? Or am I wrong on that?
Say that one more time, Eddie. I'm sorry.
Let's say if I wanted to get a lower rate on my loan, let's say I want to get a new vehicle and I want to negotiate because of my credit, most likely they will have to go into the concrete details to see what my actual credit score is.
Absolutely.
Correct. Okay.
Yes.
Perfect.
And a lot of times the soft credit score, FICO score, and what the financial institution pulls at the time that you apply for the loan are not always, they're sometimes just a couple points different.
Always learning something new, everybody. So, and if you have more, information that you want to know about our app, our online banking, Carrie is like an expert on our online banking. She's always there, honestly. Sometimes I'm like, you on social media? No, I'm going through my online banking. She loves our online banking platform. So, Andrea, go right ahead.
Thanks, Eddie. The next question is, what is the risk for co-signing a loan with a relative who has a remote history of bankruptcy?
Uh, um, pretty risky. You have to remember when you co-sign for someone, you are just as responsible for that debt and those payments as the person who is taking out the loan. You are guaranteeing that that loan will be repaid back in full. So if it isn't and you're not aware of it, anything that is reported to the credit bureau will also be reported on your credit report. So that's why we stated in the webinar to really be cautious if you are to co-sign for anyone, that you stay up to date with if the payments are being made. You know, it's very, very critical because if you have excellent credit, it could damage your credit within the first couple months if they don't pay.
I think something to emphasize that Kim was saying is, just make sure that you're very careful with doing this. I know that the person that asked, they're asking if somebody has a history of bankruptcy. But let me tell you, I have heard stories of somebody co-signing with somebody else that has like a perfect like credit history and a perfect payment history, whatever it is. And because like Kim was saying, if the other person doesn't do their due diligence, it's gonna fall on that, the next borrower. So just be careful when it comes to, being a co-signer for somebody else. Sometimes they're excited, they want to get the vehicle, they want to get the loan, whatever it is. But just be mindful. Just make sure that you think about it with a neutral mind. Don't you let your emotions take over and be like, oh, I feel bad for them. Let me help them. Just make sure that you do a responsible decision. We're not saying that you shouldn't co-sign, but it's a very, very serious, matter that should be taken very, very, not lightly at all. That's what I'm trying to say. So, because we hear one too many stories about people saying like, "Oh, I promise you, I will pay you back, and well, I'm gonna make sure I make my payments." Next, you're getting that call from, the lender saying like, "Hey, so and so hasn't paid. It's on you." And then when you try to contact them, it can be a lot of, conflict. So just be careful who you call sign for.
Thank you so much, Kevin. Yeah, those are great. It's a great answer for that question. The next question is, what is the minimum deposit for a secured loan? Do you have any additional information on how to set this up? And can we do it through the website online, or is it preferred to call? Or do you prefer to call?
That's a great question. So you have to start with putting money into a certificate of deposit, and you want to make sure that you choose a term that doesn't make your payment on the secured loan so high. So our minimum balance for the certificate is $1,000, but you do have to keep 20% in, it's either 20 or 30. It's either we'll lend 80% or 90% of the certificate balance. Remember, $1,000 of that is not part of your available balance because there's a requirement minimum of $1,000 to open a certificate of deposit. So you could do it all at the same time. You could call us if you have the money in your savings or money market account. We can transfer it right then and there to your certificate of deposit, whichever one you choose. And then we can take your loan application. It's a loan application. You're going to sign loan documents. We do not pull your credit because it is a secured loan. You're just borrowing your own money. I think someone else asked the best way to also, I was going to answer this with that question as well, to start with, their children getting credit. Another great way for someone, just remember though, no one can apply for credit until they're 18. So even if you make your child an authorized user on your credit card, it's going to report to the credit bureau. But again, they can't apply for credit until they're 18. But the minute they turn 18, get them a $500 credit card. We have great credit cards here, the best rates out there. The nation average rate right now is almost 30%. We have really good credit cards with no hidden fees. And keep in mind too that that will be reported on your child's credit report. So when they do turn 18 and they go to apply for credit, that financial institution or that creditor is automatically going to get a red flag that says, wait a minute, this consumer had credit before they turned the age of 18, and they're going to ask them, what is this about? Make sure you have that conversation with your child that this is going to show on your credit report. And when you do go to apply for credit and they ask you this question, you can let them know I was an authorized user on my parents' credit card. I was going to school overseas or whatever going to camp, whatever the situation is. Another way to empower them to know exactly what is on their credit report and how to answer those questions when they are asked. But yes, secured loans here, they're very popular. Feel free to give me a call. I would love to be the one to help you with that if you decide to open a certificate of deposit and then borrow your own money. Yeah, it's a great way to get a really low interest rate loan.
Thank you so much, Kim, for answering both those questions. Our next question is, what impact might there be as an administration seeks to reduce or close the Consumer Financial Production Bureau?
Give me a second. I'm reading this as well. What impact might there be as the administration seeks to reduce or close the CFPB? Anybody can help me out on this one? I do apologize. I'm not sure. Anybody out there? If not, we can
Sorry.
definitely
No
get
worries.
back to
Carrie's
you.
gonna jump in. I saved
Oh,
you.
thank you, Carrie.
Well, I mean, that's a good question. And there's probably a lot of information out there, but I mean, right off the top of my head, there'd be less protections for consumers, right? There's no big watchdog protecting us from, companies like looking to take advantage of borrowers. Um, what there'd probably be no sites like the one we just shared in there, to opt out. I don't know. Anarchy, I would assume. No, but that's a good question, and I really, I mean, don't have a better answer than, but I'm gonna look it up
I
and
think, I think it goes with what we were saying earlier that, when it comes to credit, things are always like changing and things like that. And this is such a relevant question because we know with so many changes happening, until the change happens, that's when we know how we'll be affected. But like Kerry was saying, perhaps some of the programs protecting, the consumer might be disregarded, but we wouldn't know until, it actually happens. But, and as Kerry was saying, there's a lot of information out there. But here in the panelist team, we try our best to answer. But that was a great question actually, because like I say, the financial field is always changing. We're always innovating, and there's always changes happening left and right. So, the more we do these presentations, the more information we will have. And then if this comes to light and it becomes something that's going to be concrete and actually set in stone, we can give you the information on that as well. But I think that was a great answer, Karen.
Well, in not ChatGPT, but like Google it right off, it says, if the CFPB were to close, consumers could face increased vulnerability to unfair practices, higher fees, that's a big deal, and reduced recourse, so potentially leading to weaker financial marketplace and erosion of consumer trust. So anarchy.
Whatever happens, at the end of the day, the United States and the Federal Credit Union, our goal will always be to do what's best for our, members, what's best for, those people that are taking advantage of our products and services. And don't always forget that we always emphasize this, and we're practicing what we're preaching. This is people helping people. So whatever decisions that we have to make on our end, we want to make sure that is what's best for our members. That has been happening since 1935, and it's not going to change anytime soon. That will be always our top priority to make sure that we provide the best financial services for you all, and of course
Yes.
protection as well. That's the reason why on the favorite app that Kerry can get away from, our online banking, you can do alerts, in case you want to get an alert when you're spending more than $200. If you want to, make sure you put alerts when you're traveling, any fraud, it can dispute as well. So that's the reason we have those layers of security to make sure that you feel safe here with the United States and Federal Credit Union.
And Eddie's
Mr.
right.
Dominguez, we appreciate you.
Yeah, even
Go
there's
ahead. Sorry.
regulatory guidelines for things like fees, credit card interest rate caps are mandated, that kind of stuff. But even though we're still like, we waived fees even though we don't have to. We don't charge overdraft fees. Our credit card interest rates are well below the NCUA mandated 18% or whatever rate cap. And those are our decisions that our board of directors and our CEO makes for our members. It's not really influenced by, I mean, it's influenced by regulatory, guidelines, but they are always shooting for below those even. So you're in good hands.
Yeah, definitely. It speaks volume, and once again, thank you very much for the question. It's something that perhaps, it will be a point of discussion, in those meetings. But we definitely want to make sure that we, as a financial institution, I'm sorry, we protect our members as well. So we hope that you answer your question to the best of our knowledge. We appreciate your patience and we apologize if perhaps we didn't say what you expected, but that's the best that we can do right now. With that being said, I think I see a couple more questions, Andrea.
So our next question is would the or HELOC affect your credit score and obtain further loans like car loans?
So a home equity line of credit goes into that 30% of amounts owed, and your utilization, specifically looking at revolving credit accounts. So this would be a home equity line of credit would be considered a revolving credit account, even though it is secured by your home. So the more credit limit you are using, the more risk you could be as a creditor. But again, this is a secured loan, not an unsecured loan. I still would be careful not to max that out at 100%. You're always making payments on it depending on the rate, and it being a line of credit, I'm sure the rate is subject to change. I don't know, monthly, quarterly. Just make sure that if the rate changes, that you determine what your new payment amount would be and that you are paying that, because some financial institutions don't automatically change that payment, and you could end up even owing more than what your limit is based on that rate on that home equity line of credit. So yes, it absolutely affects your credit score.
Thank you so much, Kim. And our next question is it a best practice to freeze your credit report?
That is a great question. I will always say yes to this, because fraudsters are getting way more tech savvy. I will always say yes to this question. You do have to keep in mind, though, that most financial institutions, even if you're applying for a new account, pull credit. If you are getting new electric, they pull credit. So it is whoever you're trying to get service with or a loan with or a new account with, they are gonna be completely stuck until they talk to you and you unfreeze your credit report. I would highly recommend that when you apply for that, you tell them, hey, how long do I need to unfreeze it for? Because I want to make sure I put that freeze back on it immediately. This is going to keep you from ever having any type of ID theft. Let me back up. This will allow, if you do have ID theft, they will not be able to apply for loans, get loans, which is what they're looking for. So they probably won't do very much damage, because what they're trying to do is get money from someone else who has good credit. So absolutely, freeze your credit report. It's instant. You would log in, you can unfreeze it yourself, put the freeze back on. You can also obtain a PIN. I think if you get the PIN, you have to get that in the mail, and then you would provide that PIN to the creditor, and then you would have that PIN changed. But I would recommend you just go in, you unfreeze it, talk to them. I've even had members or potential members that I was opening accounts for that had a freeze. They they lifted that freeze while I was on the phone with them. I pulled it and then they put it right back. So it's pretty instantaneous.
Thank you, Kim. And I believe this is our last question and comment. It says, thanks for the presentation. Does the use of coupons or taking advantage of next purchase offers affect your credit score? For example, like CVS typically offers $1 or $2 off for next purchase.
So no, that doesn't have anything. Kudos to whoever's couponing out there. I'm all about extreme couponing. So way to save money. It doesn't have anything at all to do, sorry, with your credit report.
I think we all love, coupons like Kim was saying, but make sure that you also do your due diligence, because if it sounds to be good true, it might be like a scam. We're not saying that CVS does that, but you just never know. Just make sure you do your due diligence on whatever offer that you're getting. It makes sense, and contact the vendor directly to make sure that what they're offering is legitimate. Carrie, I saw you coming off mute.
Oh, I just wanted to share for those wondering what moves might impact their score, how, like in the my USSFCU Experian FICO tool, there's a score simulator that you could play around with, that it will let you adjust to different scenarios. Like, what if I took out a car loan? What if I paid off this credit card? And it'll show you how that would change your score. So that's kind of fun to play with and helpful.
And if you go to our website, we have so many tools like that as well, when it comes to spending, it comes to budgeting, which I believe we're going to talk about next week, if I'm not mistaken. Next week is going to be a new weekly Wednesday webinar. It's April 2nd, new month, new goals, new financial dreams to meet, correct, team? So everybody has, that goal that they want to meet, maybe get that new car loan, maybe get that new home, but we just want to make sure that that you have the tools here at the United States Senate Federal Credit Union to make sure that, you are covered for all those financial needs that you may have. Once again, we want to say thank you very much to each one of you. Carrie, great content, great answers. Andrea, thank you very much for reading those questions. We know that you love to read books and that reading is paying off. So thank you very much. And Kim, as I was saying, you are our all-star presenter. And to, everybody else that's attending, we want to say that these webinars wouldn't be possible without you all. We want to make sure that you join us next Wednesday at the same time, 6 p.m. Eastern time, with a new topic. With that being said, have a great night, and thank you very much for spending your Wednesday with us. Take care, everybody.
I will
Thank you,
send out
everyone.
a recording the recording will be available by Friday, and tomorrow I'll send a recap with the slides. So to answer that
So if you
last
need
question.
any information, the recordings, any questions that perhaps we didn't answer, Carrie will be sending the follow-up. And also make sure you check our YouTube. You're gonna see our previous recording webinars. We have our webinars, our social media that, Andrea and our colleague Jasmine create organically, like everything else. And also we have many surprises. We have podcasts, we have new segments, you name it, we have it in our YouTube channel. So give us a like, follow us, turn on your notifications. I don't want to sound like a YouTuber, but it helps. So
Well, they call it subscribe, so you don't sound
subscribe,
like a YouTuber.
subscribe.
I don't know if we talked about next week, but next week is mapping your money, and it's a step-by-step budgeting workshop. So we talked a lot about budgets this evening. It's going to be a very valuable webinar next week. So please join
More
us.
hands-on. So bring your statements and your bills.
You heard from the ladies. We're gonna be paying bills and saving together. But with that being said, hope everybody has a great night and blessings. Take care.
Thank you.